Welcome once again to Kings and Queens accounting class. We are going to be looking at today how to interpret income statements. We wish for you to grasp the concept of how businesses seek to interpret their income statement so that they can give them understanding as to what actions to take for the improvement of their operations. The objectives today that we're going to be looking at we want to explain two main categories of ratios, identify the types of ratios, and to use the ratios to interpret the income statement. Okay, let's get on into it, right into it. So let's begin. What are those ratios, or what do we use to interpret the income statement, or what some other persons would have called trading profit and loss account? So let's go. There are two main categories that we're going to be giving attention to. One has to do with our liquidity ratio, and number two, profitability ratio. These are the two types of ratios that are used regularly in businesses, particularly at the end of the financial year or at the end of the half year or 6 months of operating. So liquidity ratio really is intended to determine how well the company or the business is able to pay their debt whenever it falls due. So they look at their ability, yes, to be able to pay their debt, yes, when it falls due. Profitability speaks to what extent is the business really earning sufficient, right, to satisfy maybe the shareholders, to satisfy the directors, or to satisfy the owners. To what extent are they getting sufficient return on their investments? So we have liquidity ratio and we have profitability ratio. Those are the two main types of ratios that are used. So we're going to move on now to look at the types in relation. We're going to focus particularly on profitability ratio. The profitability ratio is used in relation to the income statement. So if we're going to be interpreting the income statement, then we are going to use those ratios relating to the profitability ratio. And one of those ratios we refer to as the gross profit as a percentage of sales. Gross profit as a percentage of sales. And here what we're seeking to do is to determine to what extent we're earning, or what level of return are we getting from our trading. So the gross profit as a percentage of sales, and to find this, we have our gross profit, GP representing gross profit, over the sales figure multiplied by 100 or on the percentage, right? When our answer, let us say if it is at 20%, the interpretation of this 20% is really indicating that for every $100 of sales, you're making a gross profit of $20. All right. The second one has to do with net profit as a percentage of sales. And to find that, it is NP, which is representing net profit over sales, multiply by 100 over 1, and your answer is written in percentage. The third profitability ratio is referred to as the Royce ratio. The Royce ratio, return on capital employed. Return on capital employed. And to find that, it is our net profit over our capital, the capital employed, times 100 over 1. So those are three. There are, of course, we may also want to determine the extent of our expenses. So our expense to sales ratio. Let me erase this. Expense to sales ratio. That would be CD, or expense to sales ratio. And that would be your expenses over your sales times 100. So we have three there, four. I'm going to try a fourth one. Let's call that ABCDE. Let's put E here. And this ratio now speaks to the rate of stock turnover. How frequent are we turning over stock? So we have what is called the rate of stock turnover. Rate of stock turnover. To find that, it is our cost of goods sold over our average stock. All right. So we have 5 different ratios here that are regularly used to interpret the income statement. All right. We're going to be using over here. So we would have explained the two main categories of ratios, which is the liquidity ratio. And the liquidity ratio really is done in order to determine the big company's ability to pay its debt when it falls due. The profitability ratio, this is about the ability of the extent to which rather the business is making a profit on its operation. All right, and I have now identified 5 profitability ratios. The gross profit ratio is also called the sales to margin ratio. The net profit as a percentage of sales, or net profit to sales ratio. The return on capital employed, referred to as the Royce ratio, and the expense to sales ratio, and the rate of stock turnover. All right. Now that we have done that, we're going to apply this income statement. So the financial statement for a retail store over 2 years. And so this information in these two first columns represents 2018, and these represent 2019. So we're going to be looking at 2018, interpret this income statement using these ratios. All right. So let's go ahead. Okay, now the first one we are going to be using is the gross profit to sales ratio. Gross profit to sales ratio, which is the GP over sales, oh Lord, over sales times 100 over 1. All right. Now, the sales figure for 2018 is 80,000. Okay. And the gross profit for 2018 is 20,000. So we can put in the $20,000 over the sales, which is 80,000, times 100 over 1. All right. Okay. So what is the gross profit to sales ratio for 2018? We can take out all of this if we're going to be mathematically, and this into this goes 1, this into this goes 4 times, right? 4 into this 1, 4 into this goes 25, so 5, yeah. So it's going to be 25%. 25%. So the gross profit as a percentage of the sales, or the gross profit to sales ratio for 2018 would be 25%, right? And what this is saying is, for every $100 worth of sales, the business making $25 as profit. Okay, so for every $100 that the business is selling, $100 worth of goods the business is selling, they're getting $25 worth of profit from it before taxation and expenses being deducted. All right, we can go to the next one, which is net profit as a percentage of sales. And the formula again is your net NP over sales times 100 over 1. So what is the net profit? $10,000 over the sales, which is $80,000. $80,000 times 100 over 1. All right. So again, do it mathematically. We can say that 8 to this, 2 into this 4 times, 2 into this 50. Yeah. Yeah, split this down again by 2 and that by 2, 25. Right? And so it will be that almost looks like 13.5%. That is seeming to be half of that is going to be 12, yes, 12.5. 12.5, yes. 12.5%. Right? So it seems to be 12.5%. So 12.5%. So the net profit as a percentage of sales is 12.5%, while the gross profit as a percentage of sales is 25%. Okay, so The next task is to do the expenses to sales ratio. So which is equal to your total expenses over your sales times 100. In 2018, the total expense is $10,000 over sales 80,000 times 100. And just as we have done before, this would be 12.5%. All right. So what that is saying is this ratio is indicating that the business, right, for every $100 worth of sales, we are incurring a cost of $12.50. Yes, to get the goods in saleable, to get the goods in a saleable condition, or to operate the business so that you can sell to the customer, you are incurring a cost of $12.50. In every $100 worth of sales lies $12.50 that accounts for your operating expenses. All right, we're going to do the third one, and that would be the ROIC ratio. The ROIC ratio would require the capital. So ROIC ratio, return on capital employed, on capital employed, and that was equal to our net profit over our capital times 100 over 1. That would be, our net profit in this case was $10,000, right, over our capital, and our capital figure is $38,000 times 100 over 1. All right, so when we will be working out the ROIC ratio, net profit over capital times 100 over 1. All right, let's work it together. So when we work this out, it would be 26.3%, right? When we work this out, we'll do 26.3%. So the return on the capital, we're making 26% on our investment in the business, 26%. All right, which is below the minimum. Well, a little bit above the minimum, because most institutions want to make a minimum at least 20% on their investments. But so the year of 2018, the company would be making a return on their investment of 26.3%. That is a bit low, but still not below the minimum. All right. The other ratio that we want to do is the rate of stock turnover. So rate of stock turnover, and that is equal to our cost of goods sold divided by our average stock. Now the first thing we must do is to find what is our average stock. Okay, average stock, I'm going to erase here for space. Our average stock, define your average is equal to your opening stock plus your closing divided by 2. So in this case, for 2018, the opening stock is 25,000 plus the closing stock, which is 15,000, divided by 2. So 15, that will be now, let's say 40. So it is 40,000 divided by 2, which is going to be 20,000. All right. So the average stock would have been 20,000. If we plug in the values now, the cost of goods sold is $60,000. See here, 60,000. So it is going to be 60,000 divided by 20,000. So we can cancel all of that, and 20 this one, 20 that go 3. So we have turnover the stock 3 times in the year. We have sold out our stock during the year 3 times. 3 times we have restocked our business completely. That's what this is telling us. That we were able to sell all the stock that we had 3 times. Right? We restocked the business 3 times for the year. All right? Or that's what the rate of stock turnover is in this case. All right, ladies and gentlemen, thank you very much for sharing with us. At this time, we wish that if you like this video, that you click below the like button and subscribe so that you will know when we are able to when we are putting up a new video. Yes, you will be notified. Thank you very much for following Kings and Queens accounting class. We are grateful and we are thankful that we are being of help to you. Thanks again.